All right, crypto people, welcome everyone. Money Mike's here with another video. Now, today I want to take a different stance. So, for those of you in the UK, happy bank holiday. Now, if you're not too sure what that is in America, I hope I don't sound patronizing saying that. I hope my British accent doesn't make you feel like I'm trying to be patronizing. But in the UK, we have something called bank holiday, which is originally for banks, which a lot of the financial sector basically have a day off on a Monday about 4 or 5 times in the year, and we call it bank holiday. Now, originally it's for banks, but other businesses have adopted it and use it as some time off. Other companies stay open and stay running. So it's a very interesting thing, you know. And for us, because now if you're a Forex trader, okay, and a crypto trader also, which is important, bank holiday does have some effects on the market. So apart from a few pairs today on the Forex market, if you're a crypto trader or Forex trader, you notice that the liquidity seems to be a little bit thin. And that's because we don't have the London session liquidity coming in now. Because crypto is slightly different, the market can still move quite substantially. But for Forex, we're seeing that the market is not moving so much, especially on things like the pound, so the cable. And now, if you didn't know why the cable was called the cable, it was because there was a very large cable connecting New York and London together for the London New York session. That's how the price fee for pound USD was came around. But anyway, let's talk about crypto now. So I wanted to give you guys some rules here on the bank holiday Monday for those of you in the UK or just those of you who are passing through casually about what to do and how to trade crypto. What are the rules that you need to start out with, or what do you need to do in order for you to trade crypto properly? So I'm going to start from MetaTrader, and I'll also go on and use TradingView. And we're just going to go through just 5 rules you can use to trade crypto. All right. 5 unbreakable rules to trade crypto successfully. All right. So rule number 1, all right, I'm going to give you rule number 1 is understand the market participant structure. All right. Now, what do I mean by understand the market participant structure? So when you're trading crypto, okay, crypto, every financial market has what I call financial topology or market topology. All right. Now, topology is just a fancy way of saying the way things are arranged. Now, the term is usually used in IT for like network topology. You can have different structures of how computers are set up for different purposes and for different varying speeds, okay, or performance and things like that. Now, market topology is the same exact thing. So I'm going to break this down here as to the market participants. Now, there are quite a few market participants that can occur, all right, in crypto and also in Forex. Now, with Forex, the participants are a lot more. And the reason is now, I'm going to put this here, crypto versus all other financial markets. Now, the big difference between crypto and all other financial markets is one thing. And I'm going to put this in capital here, right here. And this is institutional sponsorship. Institutional sponsorship. Now, institutional sponsorship, all right, by definition, now within the academy, my students, they know institutional sponsorship on different levels. Now, the most generic term is the injection of money from deep-pocketed institutions. Very simple. Okay. Deep-pocketed institutions. All right. I hope I spelled institutions correctly. So when we're looking at crypto, first of all, we need to understand the topology of this market. Now, some of you have heard me use that terminology before, but never been able to really go through it. So when we look at this market, and I'm going to put this here now, one of my lovely coaches is working. And then after, I'm going to put this here for you. All right. So the injection of money from deep-pocketed institutions, this is what we're looking at here. Now, in order for a market to move, okay, now what does the market consist of here before I continue with what I was going to say? So the market or a financial market is just like when you go to the supermarket, all right? Somebody is selling and somebody's buying something, okay? Somebody's selling, somebody's buying. So in the market, we have buying. The combination of a market or market transactions is the combination of buying, all right, and selling. So this is what makes up a market, okay? Now transactions, okay, of buying and selling, the more there are, the higher the volume or the amount, okay? But volume and liquidity is not the same thing. Now, if you want to know why, okay, go on please at this moment or when the video is finished, actually, don't do it whilst I'm teaching. But after this, guys, go and check out my free session, 4-part series of teaching. Okay, it's called the Mastermind course, and in there's more detail as to what I'm saying if you want to have further clarification. And I'll do my best if there's any questions to go through it. But anyway, for now, institutional sponsorship is the injection of money from deep-pocketed institutions. Now, this is important. In financial markets, all right, deep-pocketed institutions have very strong abilities to be able to move the market both upwards or downwards. And this is important. So before you even go to analyze and start to be a crypto trader, you need to know your enemy. Now, one of the things that I love so much is a book by Shan Chu, and it's called The Art of War. Now, one of the principles from The Art of War is that you need to know your enemy and think like them in order for you to win the battle. Now, I'm seeing that a lot of people get into crypto trading, and then when they get into crypto, what they go and do is they follow signals, or they watch some of the larger YouTube channels and just follow whatever they say and try to trade. Okay, so they load up, they go to Binance Futures, they get that 125x leverage, and then they just go for it. And potentially, most of the time, it's probably going to be a buy trade because we're in a bull market. So because we're in a bull market, from the blockchain, or I don't even want to call it the blockchain structure, but from the level 2 data structure of the market, we should be in a bull run. People just go and hit the buy button and then they lose their money almost in seconds sometimes. Now, I don't want that to happen to you. This is why I'm giving you these 5 principles so that you can go for it. So principle number 1, understand the market structure. Now, the market structure of crypto is very different to other markets, okay? And I'm going to give you the market structure in terms of who came into the market first. All right, so let's go for this crypto market topology. So crypto market topology is very simple. Right here, I'm going to start with the first, and it is retail traders, okay? Retail traders. Now, you could break this down into several categories within that, okay? So I'm not retail traders, excuse me, retail traders, all right? Now, you can, again, break this into several categories. Within retail traders, there's, all right, founders, all right? So founders are people who are either the person to create a technology or directly second in line, okay? For example, with Bitcoin, Satoshi Nakamoto, okay, he's the first one to get into crypto because he's the kind of the first one to bring out the idea in terms of Bitcoin. So we can say founders, okay? All right. Another term for them is forerunners or front runners. You can say that too. The second set of people are the early adoptioners. So they didn't create any technology, or they weren't really involved in the projects in that way, but they were just early. They caught wind earlier on. So early investors, okay? Early investors. And then after, we have retail traders here. We have, to make it very simple, okay, second, let me put this here, public investors. All right, so I'm going to say the public because that will be a broader term to make you understand. So founders, early investors, and then public. All right, so this is what we have when it comes to retail traders. Now, why am I calling them traders and not investors? Now, every time you take an investment, okay, you're making a trade, okay? Everything about a financial market is a transaction, okay? When you buy crypto, you're exchanging, and I'm going to put this here because some of you may feel like you're an investor and not a trader, and I understand what you're trying to say. In other words, you don't day trade or sit in front of a chart for a little while to analyze and look for stuff. You just put your money in there and expect a ROI, but you're still trading. You're just trading in slow motion. Always remember, if you're an investor, you're just a trader in slower motion. That's all it is. But you're still a trader. Okay. Every investor is a trader. Okay. It's just that not every trader invests. Okay. Now, let's go for what we have here. So, retail traders, all right, what you're doing is you're placing a buy. And what happens? You're exchanging currency. So, US dollars, it could be dollars, whatever. I won't even put a currency because it could be literally any. For, in this case, let's say Bitcoin, all right? So you've just made an exchange there. That's what you've just done. You've made an exchange, all right? So the fact that you've made an exchange, you're trading. Bitcoin, USD, for example. I'll put the example here so that it helps. So Bitcoin, USD, you're trading dollars in to get some Bitcoin. That's what you're doing, all right? Now, what was the barrier between this and the next level of people, or what is the barrier really is a few things, but we're going to go for it. So the next level of people to come into the market this time in the market is institutionals. Now, before I go for institutional, I'm going to go for public figures first. Public figures with deep pockets. So they are still retail, all right, but they're deeper pockets. Now, when we're looking at the financial markets and we're looking at crypto trading, now this is straight from the heart. There's no script here. I'm just talking to you guys as if you were in my living room and I had a computer and I was talking to you from there. So when we look at the markets, the next people that I want to talk about before we get there is actually public figures with deep pockets, okay? The things that are, when it comes to crypto, that you want to keep in mind when you're looking at financial markets, there's a few things that are barriers for crypto or things that need to happen in order for crypto to work. Number one is going to be legal barriers that need to be broken. All right. Second one is, of course, now all of these barriers lead to one word that we're looking for, which is adoption. We want crypto to be adopted into society. It is a very powerful industry and definitely will eventually change the world forever as we know it. But there are barriers to it. Number one is legal barriers. Okay. Okay. And I'm going to put here, let me type this out. Barriers of entry. All right. This can be money. Okay. Specifically, I'll say transaction fees, for example. Country of origin. There's some countries that don't allow for crypto purchasing or very, very stringent on it. Okay. So some of you that know about crypto and know how fantastic it is, and you've ever wondered, why is it that crypto is not really, talked about in a good light, or why is it that crypto is not really, the price isn't a lot more than it should be for what value the price or what the projects are offering. These are reasons. Number one is legal barriers, and the legal barriers affect mainly institutions. Okay. Now, another thing is going to be exposure. There needs to be genuine exposure. Okay. Exposure. Now, exposure only comes from two realms. All right. It's either from the news. Okay. Well, it's from the news. All right. Celebrities or government, and others too, but you can put them into here. So news, celebrities, I won't put all, government, okay, or just notable public figures. And there is a fifth one here that I want to put out, and this is interesting too. And the fifth one is also events. Sometimes it takes an event, okay, of some massive magnitude where crypto is concerned that causes people's hearts to be turned towards crypto. All right. Now, there have been a few events which have been amazing, but people haven't really heard of it. So we need really a combination of all of these. So I need to spell this correctly. Government has an N in there, even though it seems to be silent. Government. Yeah. And then event with an S. So let's change this. So right now, I want you to get the picture in your head as to what we're going through here. And I promise you, by the time we finish this, it's going to make a lot of sense. So when it comes to the barriers, okay, and I'm going to put at the top here so that you're not too confused as to what's going on. All right. Adoption barriers. These are some of the things, okay? Barriers of entry in terms of money, transaction fee, cost, country of origin, all right, things like that. Exposure. These are the major two ones. Now, there are more, but these are the major two, okay? Now, in this first phase of retail traders, these group of people, if you want to think about how to trade crypto, you need to think about what money was in the market at this early stage. Now, there was money going into crypto, and at the time of Bitcoin, there wasn't too many other cryptos created. I think there was a few, about maybe 20 by 2011 or 2012, but there weren't that many, okay? Now, during this time, money was concentrated into just one place, and the money going into the market was very small in comparison to where we are now. It was more in the hundreds of thousands and then towards the millions a few years after. Now, the money here was low, okay? Or the amount of money in this market was very low to cause the price to be able to move very strongly, okay? And this is what happens with early adoptions. You always want to be in early when a lot of money isn't in the market because the prices are cheaper, okay? Now, the next level of people that got into this will be public figures with deep pockets. Now, the public figures with deep pockets, all right, it took somebody to be able to really get to them, or for some event or something to happen to them for them to understand why crypto is powerful. So I'm going to put them into characters. So I'll say, for example, business professionals. So for example, Elon Musk, he's a very good example. I believe he was in crypto from 2014. It seems like from what he said, he's been in crypto since 2014. All right. We have, on the other hand, we have celebrity figures. All right. So celebrity figures. So if I put this here, so the celebrity figures that we have, okay, for example, Jay-Z, okay, a more well-known one, we have Logic as well, who got into crypto quite early. And one that's probably one of the earliest will be 50 Cent, okay? He's always got something to do with money involved anyway. Okay, he went in Bitcoin from quite a while back and became millionaires in Bitcoin quite earlier on. So business professionals and celebrity figures. Now, why, for example, these guys? Now, number one, they do have money, okay? And they also have something here, which is influence. So money, okay, number one. And number two, they've got influence, okay? Which are two ingredients that crypto needs and for it to continue to get better, or not only to get better, to have a wider reach and for it to become more accepted. The truth is that in this early stage here, most people didn't get involved in it because they simply didn't know about it, or if they heard about it, there wasn't enough pulling them into the concept for them to want to put their money there. Now, the sacrifice you're going to have to make is that this is still quite early on from where Bitcoin should be in the future, but the big difference is that the price will be a lot more. The barrier to entry becomes steeper. So instead of, in 2009, I think $1 worth of Bitcoin was 1,508 Bitcoins for $1. Okay. But even then, those Bitcoins, okay, were a lot cheaper but it was a lot more difficult to see the opportunity. By the time you get here, there's still a bit of a chance here. And then we have the final level, which is not the final level, but it's just the final level for today. I will put the other levels that are available, but the final level at the moment is institutions. And this is where institutional sponsorship comes from. Now, I know, stick with me. I know I'm talking a lot and I'm trying to paint a picture here so that you can understand how to trade crypto. Now, your question may be thinking, do you think about all of these things when you trade? Yes, I do. I really, really do. Okay. So institutional, I'll just call it the institutional traders. Okay. So institutional traders, who are they? So these are a plethora of different companies, all right, and I'm going to put a list here. So, all right. Hedge funds, okay, mutual funds, all right, national or international banks, all right, put some more in here. So hedge funds, international banks, mutual funds, pension funds, okay, the list continues. Pension funds, okay, and those levels of money. Now, those levels of money, okay, are the kind of money that can cause crypto to go from a very small industry to a worldwide industry that has very, very large amounts of money being poured into it every day. Now, what is the barrier from these two levels here? So if I drew a graphical line to help you separate this out, what was the barrier? If I draw a line across here, and I'll leave it about here, what is the barrier stopping institutional traders or institutional money from coming in? Number one reason for it is legal reasons. Okay, there are still a lot of legal reasons and issues that stop institutions from fully getting into this industry. A lot of the people who are part of hedge funds that are in crypto, okay, have done it more on a personal basis, and even then there are still stringent rules around that. All right, number two, which is my own personal thoughts on this, is that the reason why institutions didn't get into this industry quite early is because it was a threat to current structure. All right. Now, don't get it wrong. Even though you may see institutions quiet and not talking about it, they really do know what crypto does do. Okay. You think that they're going to allow anything that can, in the space or the realm of finance, be unknown to them for too long? Of course not. All right. They do know what crypto has the potential to do. And a lot of it is to replace the current structure. All right. So, for example, with institutions and connected institutions, for example, with crypto, one of the most powerful things about cryptos is because of decentralization, excuse me, it removes the middleman. Now, if you want to call it the ministry of the middleman or the business of the middleman, is a business of things that, of third parties that take money for transactions. So to facilitate transactions between two parties, there's usually a middleman. Okay, and that middleman can be a company of its own, and they can make a lot of money by just facilitating the transaction between two people. Now, with blockchain, it removes the middleman, and the blockchain itself really becomes the conduit for where two people can do peer-to-peer transactions unhindered. Of course, there is a transaction fee because you have to reward the miners or people who are facilitating transactions in that way, but it's nowhere near the same as what we have with third parties. Now, the reason for it is because of the society we live in. We live in a society which, at the moment, is a society where you need to have trust that this, if you're a recipient. So if I was to draw this out here so that my speaking can make sense graphically. So let's just say that this is the sender, okay? And I'm going to put a line here, and this is the receiver, okay? So party one, party two, so the sender, okay, has to send something or send a command, a transaction or something, all right, to the receiver, okay, who's supposed to fulfill something back. So this is the pattern that we're supposed to have, all right? So we have the sender first, send something to the receiver, and the receiver then will have to send a confirmation of that at least. Okay, so this could be a transaction as simply as just buying something. Now, in this process here, all right, the person who is most at risk, all right, is the sender. All right, so I'm going to draw, let's see what I can use. Can I use this? All right, maybe not. Let's do something else. Let's go for a square. All right, so the sender is more at risk than the receiver, because let's say if the sender sends money, the receiver can run away with it, okay, and the sender is stuck. All right, because of this, and because of how human nature is, all right, in between this transaction, there is a middleman. There is a middle person, okay? And we call that a third party usually, a third party. So this third party is going to help to make sure that both sides of the agreement are fulfilled, okay? So for example, if now sender may not trust the receiver, okay, but they can trust the third party because they know the third party, which is usually the case. And so when they send a transaction, what actually happens is we have sender to the third party, and then from the third party, it gets to the receiver. And then what happens is, because the third party is connected to both ends, then a receipt for that transaction, whatever it is, can be sent back to the sender. So we have this kind of triangle formation that happens. All right. Now with blockchain, we don't need that because we have a public ledger of immutable results, and with smart contracts too. Okay, which are smart contracts are just programs. They're not actually a contract, but they're just lines of code which run automated and can't be interfered with either the sender or the receiver. And so we don't need a third party in here. We can get rid of Mr. Third Party, and that immediately gets rid of a lot of transaction costs and possibly even speed restrictions too, and things of that nature. So when it comes to what we're looking for with price structure here, one of the biggest things that we can go for at the moment would be to keep this in our head. All right. So I'm going to continue on. I hope you guys, if you have any questions, let me know. If you don't have any questions, then we continue. All right. But for now, I want you guys to keep this in your mind. All right. So institutional traders, legal reasons, threat to current structure for some of them. And so rather than allowing crypto to happen, they're fighting it. Okay. So for example, with some of the structures that we have in society, they're causing issues with allowing crypto to be crypto. All right. And then there's other institutions that are now taking it on, and laws are starting to favor them bit by bit to allow for something like crypto to be adopted. So why does this help with trading? Now, not every crypto has this topology. There are some cryptocurrencies that have a topology which is primarily retail traders, okay? And I'm going to put the rule here, or the wisdom from everything I've just said here, which is this, right? The more retail liquidity, the more volatile the price. Now we're going to need more space here, so I'm going to try to put this here. So the more retail liquidity there is, the more volatile the price is, okay, or will be. Why is this? Now, think of money in the markets as an anchor, okay? The more anchors you have on the ground, the more difficult it is for, or in the sea in this case, it's more difficult for a ship to move or move even at all. So money acts as a cushion, okay, to support buying and selling. The more money there is, the more liquidity there is in the market, the more of a cushion it acts as for buying or for selling, depending on what direction money is driven to. So when you have a market which is highly liquid, okay, and is the amount of liquidity in there is mainly retail, then you run the risk of it being very volatile, okay? Another risk that you run of, or another risk that can happen, number two, is So I'll put number 1 here so that you guys can have this. So here is our number 1. All right. And I'll put number 2 right here. I try my best to keep it within the space. Now, MetaTrader screens are quite small, so can't fit that many stuff in there, guys. So I'll try my best. All right. So the more retail liquidity, the more volatility the price will be. Now, if there's a market that is highly liquid, okay, which comes from retail traders, it doesn't necessarily mean it's bad, because it's still, again, the term here, highly liquid. So there's money in this market, okay, for buying and selling, okay? But then what would have to happen here is that there will be a few things that could potentially happen in that market, okay? So number 2 is that you're going to have high volume, okay? So high volatility, high volume, but low price cushions. So price cushions is a term I'm using today to help you guys. Supporting price levels. So support for price levels will be low, but you could have high volume. So this is why there's certain cryptos, okay, which I'm not naming names at the moment, but there's certain cryptos that can really push up very strongly high, but then in the same breath can shoot down all the way back down to nowhere, okay? And the reason for this is quite simple. It comes from the fact that when it comes to markets that have high amounts of retail trader liquidity, okay, and volume, there isn't enough money in the market usually to support very strong movements long and short. Usually if the price goes long and short or up and down, what you're going to find is the price can't sustain those movements for long enough for you to be able to trade on. Now, remember, trading, okay, we're trading on a lot of higher time frames than the daily time frame or from the weekly or the monthly, which is what investors will be doing. What we're doing here is that we might be trading for a few hours, a few minutes even, and maybe possibly a few days as well. You may hold some trades for more than a day. But the key here is that you want to understand, first of all, is when you're looking at crypto, so what's the wisdom here? When you're looking at a crypto, before you go dive into Binance and sign up and say, yeah, I'm going to go and trade crypto. I'm going to trade, I don't know, some crypto that you saw in a list that's just been listed on Binance, for example. You need to consider how much money potentially is coming from retail traders, okay? If the retail trader amount is very, very high, doesn't mean you won't trade it, but then you just want to strategize on how you're going to trade it. Are you going to be trading it for several days, several weeks, several minutes? This is the question that you want to make for yourself. Now, the more institutional money there is within a crypto, okay, the more stability you're going to have with the price. All right. So I'm going to give an example of something that's recently happened here. So if I go to Bitcoin, I'm going to open up another chart. I'm going to pull out Ethereum as well. And then I'm also going to pull out, let's go for one, Doge. Okay. Very, very easy example to use with Doge here versus Ethereum. So here's Doge here. Here is the Ethereum. If you're not too sure what Doge is, Dogecoin, and ETH is Ethereum. All right. So let's start off with Doge and let's do some quick maths here. So we know famously that the market has crashed not too long ago. About 3 months ago, everybody was in despair, okay, because the price just took a crazy turn to go down short and nobody could even understand as to what exactly is going on. But either way, let's do some maths here. Now, when the price was making its way up, the strength of the price was, from the looks of it, was very strong. When we got to this point here, now, if you want to test how good, just the same with a building, guys, if you want to test how good a building structure is, you need to test it. The best test will be when the weather is bad, when things are not going so well, when there's weather that could, alter the structure of a building or break the structure down completely. That's when you know how good the engineering of a building is, okay? So testing the structure of a market or testing how resilient a market is in terms of its liquidity, you're going to have to test it during bad times. And how do we make a test? So a very simple test that you can do, okay, is to look at what happens in a crash cycle or something where the market takes a very strong downturn movement. Okay. Now we want, in essence, every asset to go up. Every crypto is an asset, or is supposed to be an asset. So primarily with an investment, is always good when it goes up because it means it's gaining value, which we want. Now, when it starts to lose value, the key here is that we want to see how much value that crypto is actually losing, because that will help us to know what's going on, and not just how much value is losing, but how fast is losing that value. Okay. So rule of thumb here is that if you're in a market, if you're in a crypto that gains value very quickly, but also loses value even quicker and more value than it even gains, then there's a problem. That means that we don't have that cushion that we're talking about here. Now I'm trying to be as simple as possible. I will do this over many series. This is actually just part one, but let's go over this and have a look at what's going on. So I'm just going to use the month of May. Now, if you're not too familiar with TradingView here, each line on the daily time frame D1 represents one trading month. So I'm starting in May. So from the highest point to the lowest point that we saw in May doesn't mean it's the lowest point of price. We're going to do a quick calculation here to work out something. So we can do a very simple piece of maths here. So the high is, according to this, when I hover over the crosshair, 0.74146. All right. So 0.74146. So we're going to call that, so far, that is the all-time high so far. So ATH, as we'll call it. All right. Now, the low, I can hover over this candle here. And if I hover over the low here, it says 29,480. So just shy of 29.5, excuse me, 29.5 cents. So I'm going to go for 0.29480. Now, what is the calculation here that we're going to do? All we want to do here is just calculate what I call a loss of value. How much value did this crypto lose in this period of the crash? So if I was to, instead of doing this, let me put the actual division sign. So to calculate this, guys, the calculation here, let me put the low so that you guys know. Low of May crash. All right, again, this is not the lowest low. There are lower lows that the price went to, but this is just to take a period of time as a subject. So when you're doing your analysis, guys, you want to test this out. You always want to take a period of time which is common to everything. So for example, when it comes to the coronavirus in March, you want to look at, if you're taking a picture as to what's going on with different, I don't know, stock pairs or stock assets, then you want to look at the coronavirus period, but then over multiple assets to assess what's going on the stock. Very simple, same kind of thing. So what's the calculation here? Very simple. We're going to divide what the low was by the all-time high, so 0.74146. And then we're going to times that by 100%. And then we're also going to take away 100%. Now, why am I doing this? The reason I'm going to do this is because we want to calculate how much percentage loss from the all-time high did this asset lose. And in this case, this is Doge. All right. So if I was to do this, I'm going to get the calculator here. So let me get the calculator so we can do this together. All right. So if I get the calculator right here. Okay. So if I get this calculator and I show you, switch to a bigger screen so that we can see. So calculator here, we have 0.29480 divided by 0. I'll just type this in, 7474146, and that equals to that number there, times that by 100. Okay, and then we got to take away 100 because we want to work out what's going on. That gives us a value of 60%. So in other words, from the all-time high, in that movement, Dogecoin lost 60% of value lost. Okay, 60% of the value of Dogecoin was lost in this period of time. All right, let's go to Ethereum now. So Ethereum, I'll go to the daily structure here, and let's have a look here at what we have. So the all-time high for Ethereum is right here, and the low for the that month of May is right about here. Now to quickly do this, all right, we're going to need the crosshair tool again to get this accurate. So I'm going to hover over here and we're looking at a high of 4367.49. So I'll write that there, 4367.49, 4367.49. And that is the all-time high, okay? So from that all-time high right here, let's go for the low. So the low right here is 17, according to this, 1753. So 1753.06, 1753.06, and that is the low of May crash. All right, so we have our two values here again. So I'm gonna put this here, May crash, make sure we got that. So this is the low of the May crash here. So if we're gonna do a calculation as to what exactly is going on, all right, what we're gonna do, I'll delete this here. Put in all of that. And let's go from the beginning, clear it all. So 17530.68 divided by 4367.49, all right, equals 2, times that by 100, okay? So there we go, times, take away, all right, 100, okay? So 59.86, okay? So here is what we have, 59.86. So in this case, from the all-time high, we had 59% decrease. So confusingly, if you were to be confused now, you think, oh, well, Dogecoins was 60 and this is only lost 59, okay? But how do we do the rest of the calculation? So the last part that you have to do is going to be the bounce back, okay? This is important. For this to make sense, you can't just do just the high and the low, you've got to do the bounce back. So the bounce back will be where? It's going to be from that same point, so the low. So I'm going to draw a line across here, even if the price is going to be a bit lower, to where the price is currently at right now, from where you're, or from the highest point in that month or the month that you're in, okay? So to do this, to finish off, this highest price point we had here, just quickly calculate this. Now, this is due diligence that you have to do. All right. Before you trade, you want to make sure you do due diligence and not just go from a tip off. All right. Otherwise, you will get yourself in big trouble, especially with crypto. Okay. And I explained to you why. I'll go back in a moment to explain this point. So 3376. So 3376.28. All right. So highest point so far since the bottom or the low, okay? And then after, we have to go from there, and then we will know our calculation. So our calculation for this one is going to be, I'll put this here, since the low, how much has the price recovered by, and how far is it from the all-time high? So you can do it in two ways. The easiest one is just to do the latter, which is just to look at the all-time high from here. So if I go right here, 4367.49. All right. Let's do the maths here. So I'm gonna get the calculator now. I think I closed it, which is a bad idea. Let me get it back again. All right, so here we go. Make it smaller so you guys can see this. All right. So 3376.28. Yeah. Divided by 4367.49. Okay, I've got 48, but it's okay, it's very close. All right. Times 100. take away 100. And this is give or take about 22.7%. So what does this number mean? So 22.27%, that means that we're only 22.7% away back to the all-time high. All right. Now, why is this important? The speed at which the price recovers tells you a lot about what type of money is in this market. Okay. Now, usually in market crashes, if you want to have another rule of thumb, in market crashes, places where there's institutional interest, hear me carefully, not institutional sponsorship yet, but the interest to buy and purchase an asset, the price will recover a lot faster. Okay. So from here, we're only 22.7% away. Okay. So from the point of recovery, if we're going to calculate the recovery period, we're going to work out how much has the price grown from here to here. All right. So from the bottom, we could say approximately almost 100%, or the price has already doubled. Now, how do we calculate this with Doge? So what we're going to have to do with Doge is if I draw a long line across here, we can work out how much the price has recovered from looking at the all-time high. So the all-time high is still this number here, 0.74146. The low of the crash is still the same right here in May. And the current pricing from where the day is, or where the day is right now, is Doge right here at 35. And I'm going to use this cross here. The high is 35.123. Makes it very easy because it's 123. So how do we calculate how much recovery you have? So all you have to do is from the current price to the all-time high is going to be 0.35123 divided by 0.74146. All right. And times it by 100. Okay. So that ratio there is going to let us know where we are. So if I do this calculator, now 0.35123 divided by 0.74146. So now I'm taking the all-time high and the current price here. And so far the price is just under 50% away from the all-time high. Just under, excuse me, times 100 here. All right, so we still need another 53%, in other words. So the price is 47.37 from where it's supposed to, from where it is now, or the highest point we had, I should say, not where it is now exactly. But in order for the price to get to its all-time high, then it's going to need to double and some. So another 53% more, okay? Now in the other calculation here, so oops, divided by 100 again. Don't know what I did there, yeah. So in the other calculation here, I took the high point to the all-time high and we're 22.7% away. So we can see that there's a much larger recovery in the price than we would see here. We're only 22.7% away. Now, for you to calculate that, you got to take away you got to do the calculation here and take away 100. If I do the calculation here, we're actually 53% away. So 53% away. All right. So if we were to do a quick ratio here, now I know this was a lot of maths and a lot of talking. Again, I'm just talking to you guys. This is unscripted. This is not, this is a one take thing. So if I do a quick ratio here, all right. So 22.7 and 53. If we work this out here, 22.7 to 53. All right, as a ratio now, because there's a decimal point here, we can't work this out. But in other words, if I was to do the maths here, or the other way to do this is just to divide, and then the number we get would be for the latter. I'll show you what I mean. So 53 divided by 22.7. What am I doing here? I'm looking at the ratio of recovery now. So the ratio of recovery, 53 divided by 22.7 equals to 2. So in other words, what this works out to be is that for every, all right, so 2.33, if I write this here, so for every 1% recovery on Doge, it equals to 2.33 times more on ETH, all right? So this is what this basically means as a ratio. Now, what does that let you know? That there's a lot more institutional money, if there is even any at all, on Doge with Ethereum than there is with Doge, which is leading me to the second point here. And I promise you guys that you're going to enjoy this. So coming back to all of the notes that we had here. So these are the barriers that we had: legal reasons and threat to current structure. Okay, but primarily legal reasons, because many institutions know that crypto is going to take over the world, literally. All right. Now, when we're looking at the structure or the topology of a crypto, all right, one of the things that is important is that when institutions invest, they have to make sure, of course, they fill all the legal reasonings, but they also fill out all of the price point reasonings as well for themselves. Okay, so that means that if an institution is going to invest in a project, then it needs to have the incentive or financial incentive for them to be involved. Now, I've spoken about Doge quite a bit extensively before, but one of the things that you want to keep in mind when looking at Doge is economics, okay, or tokenomics, okay. Now, one of the things, I'll just write it on here, because when we're talking about high volume, okay, from retail traders, there's something else that can happen too, and this is important for you to go through. So when it comes to crypto trading, all right, the second thing that can happen here is lack of liquidity to get out of a position, okay, trade position. So think about this, guys. If the volume's high, that's cool. There's a lot of transactions going on. All right. Now, volume does not equal to liquidity. And I just want to put this out here. Me being a Forex trader, it's important for me to share this background with you about volume and liquidity. All right. In the financial markets like Forex, Forex has high volume and high liquidity because literally every person somehow in the world is interacting with this market at some time. It's very well spread across the whole world. So there's mass adoption, if you want to put it there that way. Now with crypto is not the same. And number two, the type of people, I'm not saying that retail traders are bad. There's not enough money in the market to sustain, okay, fluid price action and flow. And some exchanges do know this, and the exchanges with less volume in there do a few things to kind of make up for that. But stick with me for a moment. So lack of liquidity to get out of a trading position. Okay. Now volume does not equal to liquidity. Does not equal to liquidity. All right. They're related terms, but they're not the same. Okay. So I'm going to put this here to help you understand crypto trading so that you don't make these messes. Number one, all right, volume equals to the amount of money within a financial, amount of transactions within, I'm thinking about liquidity, that's why, guys, a financial market. All right, so volume is the net amount of transactions within a financial market. So the net amount will equal to the volume, and this can be a volume is usually measured over a period of time. Okay, so liquidity, number two, is the amount of money. I'm going to put here net because the net will make more sense. The net amount of money within the transactions in a market. Okay, I'm going to need to do something here. Let's do some tricks. I'm going to delete this, take the financial market, stick that right over here. I'm going to change this and add net. Okay, so the net volume. So for example, if I was to give a quick example of Dogecoin here, if I hover over this candlestick right here with the crossing, I'm not too sure if you can see this very well, but to the bottom right here, we have, it says default, and then we have the date, which is the 16th of May, 2021. Then we have O, which means the open price, H, which means the high, L, which means the low, and C, which means the closing price. Okay, now the V okay, means volume, okay? And volume is measured in, depending on what you have. Now, the volume is usually K, which means per thousand. So 509,753 times 1,000, which means that within this candlestick here, there was 509, excuse me, I'll put this here, 509,753 transactions times 1,000. So we're looking at about 5.09 million transactions within this day, okay? So those transactions, okay, would have a net amount of money that accounts to or comes to, but the two things are not the same. Now, usually with trading, many people get this mixed up and they say because the volume is high, the liquidity is high too. But the volume can be very high on a day or higher than another day, but the liquidity is low. All right. Now, usually if the volume is high, the liquidity will possibly be higher, but that's not always the case. In crypto, to some degree, is a lot more true. But if, for example, in Forex, you could have a very high amount of volume, but low liquidity. Okay. So these are the keys here that you need to keep in mind. So looking at a market, okay. Whenever you're trying to analyze where you're going to trade and what to do, you have to keep to the rules. So let's do a quick recap. So understand the market participant structure. Okay. So if it has what you're looking for in conclusion here is going to be a market. All right. So I'm going to put what we're looking for, what to look for. So you're going to look for something that has, all right, high amount of institutional interest. All right. Now, usually when there's an interest there, even if companies claim that they haven't bought anything, they probably have already, and they don't want to spike the price, so they're not going to announce it until later on. So high amount of institutional interest. Okay. And that can translate. One of the things you want to do is look for something that has a large market cap. So I would say anything, for you to be safe, anything more than 500 million in market cap is safe to trade for me. Safe to trade. Now, if you want to find this, you can check this out on CoinMarketCap. So if you go to coinmarketcap.com, www.coinmarketcap.com, you want to find that out. All right. So high institutional interest. Number 3, you want to look for a crypto which is listed on many exchanges, okay? Listed on many exchanges. So being listed on many exchanges, what benefits does this have? Now, there's 2 benefits. There's one which I would say is, I'll put it into 2 categories. So the internal one, or internal advantage, okay? If a crypto is listed on many exchanges, then it's going to, number 1, of course, build trust. So internally within the exchange itself is going to build trust, okay, from the people, because people are seeing that this is listed everywhere. So the crypto must be good and the exchange must be good, okay? So it does build trust, okay? Okay. It will also have good pricing compared to other exchanges. All right. Now, those are the main internal advantages. There are more, but because of time, I'm trying to keep it short and sweet. You guys are gonna have to come back next week for the next time. No, I'm joking. You guys can come tomorrow. I'll do part 2 tomorrow. I'll list out the second rule. All right. But anyway, external. Okay, main one, which is good for people or for the greater world or externally, is going to be something called market arbitrage. Okay, market arbitrage. So market arbitrage, yeah, is, as it is, if you know what the word arbitrage means, if you add market to it, is very simple, but I'll give you a simple definition here that you can run with. Okay, the buying and immediate or close to immediate, or I'll just put immediate or close to here, selling of an asset of the same asset for profit. Okay, and I'm gonna have to extend this here, so I'll put this down here. So market arbitrage, which is a legal way to be able to trade, is buying. Let me change this quickly to make sure it makes sense. Put this here. Now, the key for arbitrage to work is that it has to be the same asset. So for example, if you, and I'll make up an example here to fill in the gaps here, but let's see. For a profit due to different exchanges. Okay. It could be more, but this is arbitrage. Okay. Now, if you're not too sure, but what makes the price, and I explain to you. So for in an exchange, especially for crypto, all right. All right, crypto exchange price. Let's do this. So a crypto exchange price, where does it come from? The price comes from a few things, okay? So it's going to be the net buyers, okay? To the net sellers, okay? Number 3, any internal holdings. For example, in the crypto price listing, internal holdings by the exchange, okay? And then the volume, okay, plays a part too. So these are the 4 simple major things that happen. All right, now each crypto exchange has their own market order book, okay? So I'm going to put this here. Each exchange has their own market order book, okay? And this market order book is controlled for exchanges for now anyway. And when I'm talking about exchange, by the way, to come correct, I'm talking about centralized exchange. With decentralized exchanges, the pricing is slightly different and the structure is different completely because we don't have centralization here. All right, but I'm talking about for a centralized exchange, for example, Binance or something, or KuCoin, things of that nature. Each exchange has their own market order book, including decentralized ones. So this is what causes the price to be the price. Now, if, let's say, and I'm going to write this here, let's say we have something like Cardano, so ADA, all right? A very simple example of arbitrage is here. On ADA, let's say on exchange 1, so I'm going to call it EX1. So EX1, Cardano is worth $2, okay? And from the net of all of these 4 things I've talked about, the calculation that the market order book and the broker exchange gives, or the exchange gives for you as a price to buy or sell at, is $2, okay? And of course, this is constantly changing with the, recalculated very, very quickly every second or every other second, but mostly a second or milliseconds actually, all right? So this is one side. The other side here, Cardano, let's say in exchange number 2, on a different exchange, Cardano is $2.04, all right? So $2.04. Now this price difference here, if you're holding Cardano on exchange 1, all right? So if you're holding Cardano exchange 1, so if you exchange 1, you're holding, say, $10,000 worth of Cardano, which is 5,000 Cardano, according to this calculation. So 5,000 ADA, because it's just 1,000, 10,000 divided by 2. All right. If you're holding 5,000 Cardano on this side, all right, what could you do? Now, it may not be much, but this is how arbitrage works. Now, market arbitrage can be done by retail traders, but it's usually done by institutional traders. So the thinking here is for you to understand is if there's institutional interest on a crypto already and it's already listed everywhere else and there are price differences, even of a penny, if institutional money has, millions of dollars inside of it, they might possibly will be taking advantage of the arbitrage. Now, hear me out carefully, because not every crypto, and this is what we're going to go through in part 2, not every crypto that is held by institutions is bought through an exchange. Because of the amount of money, there is sometimes other ways that they buy crypto. All right. And we'll go through that tomorrow. But let's just say it was an institution who was doing this just for the same sake. In exchange too, this same 5,000 ADA is not going to be worth just 10K. It's going to be worth a bit more. It's going to be 5,000 ADA times the new price of $2.04. If we do the maths on that here, let me get the calculator. Now I know that there's a lot of stuff going on, so I'm going to put exchange 2 here, and then I promise we're done. So exchange 2, let's go and do the calculator. So 5,000 divided by $2.04 equals to $10,200. So by arbitrage, so you're buying and selling the same asset, okay? You've earned $200, all right? For the same asset, just using 2 different exchanges. Now, in different financial markets, this is one of the ways institutions make money in financial markets, because they have very, very powerful computers and algorithms that can process these figures and actually provide them with arbitrage opportunities and buy and sell within seconds. The only slow part is that when it comes to crypto, because there isn't that much connectivity in the financial markets of crypto compared to Forex, it's not as easy to happen, but it still can be done to a certain degree. All right. So this is one of the things that are important here with market arbitrage. So the external benefit is for arbitrage to happen. So if you find a crypto that can potentially happen on, that has a large market cap, has good trust now, good pricing, okay, and we have the high institutional interest, then it will be safe for you to trade there. Now, because of time, I thought that it would be quicker to do. I guess I'm just sharing from my heart. So I'll be doing these every day around about the same time. If there's any questions, leave them in the comments. If you enjoyed this, please let me know. All right. I'll be back with another video. All right. Tomorrow, same thing. But what I'll quickly do is analyze Bitcoin. Now, because of bank holiday, I'm just going to continue from my notes here. Let's have a look at what we have going on. I'm going to pull up my charts here first, and then after we can have a look at TradingView also. All right. So let's have a look at the charts here, and let's look at Bitcoin. So Bitcoin at the moment, the market structure for the bullish side of the market is still holding. All right. And because things are a bit slow today, there wouldn't be really any trades I'll be looking for. I already shared the crypto market with the students in the Wealth Group Academy, and markets are still slow. There is opportunity, I guess, for some buys or sells, but this is really splitting hairs. We want the real good movements. But recapping anyway, on the daily time frame, the supply zone to the left here, we've had a body close and a break above. So we're above the area of this point right here, 17th of May, when we had major supply pushing the price short. Now that we've had this break back the other way, the body of the candle has closed above this region and return. So supply has become demand, and we're looking at the price continuing to give us a long. And so far, we've seen that. We've seen the A swing form. We had a very strong close here, this blue line. This bullish candle closed above about 3 days of price action here from the previous highs, which is a very strong intention of bullish continuation. And then we have the pullback here where everybody was kind of getting scared that crypto was crashing again. And that was just a short-term pullback, and we see very large bullish candles. Now, the price has fanned out quite a bit, and at the moment, we're seeing the price form this structure here, which is in line with bearish price action or bearish movement. So we should be expecting a pullback. Now we've had a complete cycle of price here anyway, with the price getting to the 50K mark. Here is the A, and here is the B movement here. And now the next phase is here at C. And we should be expecting the price to be making its way back up here for the D. Now, what I'm going to do is with Bitcoin, I'm going to open up another chart again instead of using that chart because it's already marked out quite well. And I'm just going to go down to the hourly and let's see what's going on. Now, I already have markings for the hourly here. So I'm going to show you guys, for those of you who haven't been following what's going on, I'll show you the hourly chart from before, not this one. I have quite a few. Let's go, not this one because that's not marked out. Let's get that out where it is. Let's get to the one that I have marked out. Is it this one? No, this one is marked out, but there is one that I've marked out more cleanly. If it's not there, it's okay. It's probably on this end here. All right, here we go. So here's one and here's the other. This is the one I'm looking for. So I have quite a few here, guys, but this one, just to recap on where we are. So here's A and here is B. So the same structure we're looking at on the higher time frame. Here's the trade I gave you guys for the long, and you can see the price has done a fantastic one. And what we're seeing at the moment in terms of market structure is we're still above the 50% level. So I do expect the price to drop a little bit more. And all we've seen is the price accumulate here, this area right here, and it's gone for a long. Now, if I take off all of these markings here, just to make things look a bit more simple, because it does look overly complex. It's just that we have markings from the previous week here. Take off all of these lines too. Where are we right now with the price? Well, we already had this long, so we don't need to put this here anymore. I think you guys got the point that I was right. I'm joking, but you guys have seen the price take off from the long where we were expecting anyway. The price has done what it needs to do. So I'll delete all of this. So where are we right now? So as to where we are right now, I'm expecting the price to pull back a little bit lower. This is this pink line range represents our area of strong demand for the price to continue going long. Today has been quite a quiet day. We've seen the price sell off a bit from supply from Saturday, but nothing much really going on at the moment. So what I would say here, this accumulation of orders right here for the price to go long was a very key feature. And since the price used this special area we talked about, I'm intrigued to see what the price does in the future. Now, it could break down lower and come back up for another long if there's not enough demand to support the movement to go past 50K. If it does do that, then there will be a cheaper re-entry, which means for other cryptos, which I'm not going to go through for now today, would mean a cheaper opportunity as well. Now, this applies on why is this so important? Because it was the one that produced a short here that we saw the price return before a massive long. So we had a break above return and then a very strong long. And you can see as soon as the price got here, the structure of the price changed from this body kind of movements to lots of wicks. All right, now without going into too much deep detail now because of the time, this form of price action here is important when it comes to the shift between the supply and demand. But for now, this accumulative area here produced a long. So I'm expecting to see either the price return back here and continue and break past this high especially and go and continue towards the 50K mark again, or the price should be breaking down lower and giving us a lower down entry. So in this case, if in terms of crypto, I would say give the price a day before you react to anything. Let bank holiday pass in the UK. I'm sure many people are taking a break and not probably thinking about crypto too much. So once everything is back on again tomorrow, then I'm expecting to see more activity in the price. Okay, and that's really it in terms of the breakdown. Sometimes it's very simple. For now, I'm not looking for any trades in particular. I'd rather let the price play out as it should and give us more information and price data for us to pay attention with. But guys, I hope you guys enjoyed that anyway. And I'll be back again with another video very